Hey traders, welcome to this video. So today I'm going to show you how to properly set up a swing trade. You're going to be looking for 5 key variables that imply price action will be in your favor. Please note that with TA, it does not tell you where price action is going, but with the variables I'm about to show you, you will have an edge that will be better than a coin flip chance of price continuing in your favor. And for those who do make it through the video, I do have a secret 6th key that you won't want to miss out. Let's get into it. So the 5 keys that I have for you today are 1. Understanding key levels, historical support and resistance. 2. 786 and 886 retracement levels. 3. Recognizing Bukowski patterns. 4. Understanding and recognizing divergences on both oscillators. And 5 is understanding and recognizing Japanese reversal pattern candlesticks. So let's get into the first one, identifying key levels of historical support and resistance. So when you want to identify a level of inflection, you really want to know, A, do all market participants view this on a global scale? Does everybody recognize this as a perceivable swing low or swing high? For example, I have Uber pulled up here, and when we're looking at Uber, we see price reacts here at 47.07 and reverses. You also notice in here some consolidation at a previous level, a slightly lower, where you do have reversal as well. So this here is where you would plot one trend where it acted as resistance. You'd plot your second trend here where it acted as resistance, and you always want to start in the beginning of the data, right? So more data on the chart is better, and if you have years and years of data, you can always pull up the weekly as well. Currently right now I do have the daily pulled up just because this starts in this chart inception is from May 2019. So looking at that all the way back is where you want to plot your first support resistance, and as you follow along and time progresses, you'll realize that buyers and sellers do have limit orders and sells and stops at these locations. As we go through support, resistance, resistance, resistance. So this will be a major level of inflection. In between here could be an area of accumulation or distribution. And you'll see at the bottom here as well. So price comes down, tags 25.69 and reverses. You also have here one time in history, price comes down, tags 28.43 and reverses. So early on in this chart's inception is where you want to plot. So just to recap, further back is better, more data is better, and you want to always start your plotting of trends of historical support and resistance as early in the chart's history as possible, and then work your way forward. Key number 2 is going to be using your Fibonacci tool, and you always use Fibonacci like a book, left to right, just like you're reading. You never want to go right to left, you want to go left to right. So if we plot here our COVID crash low, which is discernible to all market participants, and you plot your next point at the buying climax or the all-time high, so COVID low to peak, your 786 and your 886 are value perceived areas where definitely you can just kind of think of this as this asset is now 88% on sale, 78% on sale from its previous peak. These are areas of accumulation where deep value is perceived and potential bids could come in. We didn't quite make it all the way down to the 886, but we definitely reacted at the 786, and now we're holding the 786 as support. So big mega tech stocks probably won't see the 886 just because of the level of demand that they have, but a deep value perceived area on bigger mega cap stocks would be a 786 for sure. And if you don't hold 786, you'll likely test the lower range at an 886. The third key that you're looking for is you definitely want to try and identify a Bukowski pattern. So for example, on Bitcoin, I have a rising wedge, a falling wedge, bear flag, rising wedge. So these are definitely patterns you want to be aware of, especially in this example. The rising wedge is at the top of a range, which also could be another double top, which is another Bukowski pattern, and your falling wedge is at the bottom of a range. Much more high probability than, for example, let's say this rising wedge at the bottom of a range. This one happened to have played out, but definitely you want to locate these towards the top of the range. But definitely can always play out, so something to always keep note and something you always want to try and identify. If you're having trouble identifying these patterns, go back to old charts and just bring up as much data as you can and try and plot these and see if they've played out. Another example I wanted to bring up was US oil. This happens to be on the weekly time frame, but what you have here is a ascending broadening wedge, and this happened back in 2018 where this pattern did play out to the downside. You do have this other bigger structure here, another ascending broadening wedge, which happened to have a breakout and back test of the pattern. You will want to look for some follow through to the downside if this pattern is going to play out like this one here. Another example of a pattern you want to recognize is inverse head and shoulders. I have this example pulled up on the NASDAQ. This is the daily time frame. So you do have one low, a lower low, then a higher low, creating your shoulder, your head, your shoulder. Your neckline would be here where you have the most touches throughout the pattern. So you'd want to watch a break of the neckline. And this so happens to be also at the bottom of a range where it has acted as support, 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 and price has reversed off these levels. So this could potentially be a momentum shifting structure at the bottom of a range, where something you want to pay attention to and try and identify. You could play this with a minimal risk below 11,022, just playing the structure alone. If you do see prices start to break back below the head of the pattern, your argument is going to be invalidated at that point. Another example I have here of another recognizable pattern would be your double bottom, where you have one low followed by a slightly or same low, implying that traders are settling up here and finding support. No matter how hard sellers are trying, they are failing and buyers are stepping back in. So first time, nobody knows if this is a local low. Second time, everybody knows that this is a local low, and you do see prices rally off of this level. Another Bukowski pattern that I really want you to be aware of is the cup and handle, where you do see this rounding pattern, which is your cup, followed by a broadening wedge formation, which is your handle. You play this with the breakout of the top supply line, and typically your measured move is from the bottom of the cup to the neckline, followed by the break. And this one definitely was a overperformer, but this is definitely a structure you want to look for. And you also see that it was at a historical inflection point where it's been support and resistance before. So the fourth key that you're looking for is going to be divergences on both oscillators. For this example I have here is DraftKings, and this is going to be a MACD bullish divergence. You'll notice you have one low followed by a lower low followed by your third final lowest low. But what are you doing on your MACD? You have your first low here with high levels of negative momentum, followed by your second lower low with a higher low on negative momentum, followed by your lowest low with your highest low on negative momentum, implying sellers are exhausted, and no matter how hard sellers are selling off, you can see the selling pressure is exhausting from one low to the next. This is going to be a triple bullish divergence, which ushered in a relief rally. In the short term, where you see your positive momentum building, you do have earnings coming up, which something I don't recommend playing, but you'll see what ushered in from this triple bullish divergence is a nice rally to the upside back to a level of inflection. But ideally you want to see bullish divergence on your MACD and on your RSI to even have a stronger argument. If you just have one of the two, you could take a shot at it, but for a stronger argument, you definitely want on both oscillators. And just to give you an example of what bearish divergence looks like on both oscillators is here you have your MACD histogram island making one high, relatively same high with lower positive momentum, creating a bearish divergence from one peak to the next. This is your MACD, followed by your RSI, your one peak to the next peak, where you have slightly lower levels from one high to the next, ushering in bearish divergence on both oscillators now, which gives you an even stronger argument for impending price action follow through to the downside. And what happened? It actually played out, and this is what gives you that slight edge. We never know where price is going, but when we find these variables, it does give us greater than a coin's flip chance edge that price will continue in our favor. Another thing I wanted to point out is something that we call hidden bullish divergence. Also could be hidden bearish divergence, depending on your example. For this example, in the dollar, the DXY, you have one low with a higher low, and you'll notice on your MACD histogram island, your one low, followed by your next higher low has a lower low on negative momentum, implying sellers are trying as hard as they can to push prices down on momentum, but you're making a higher low, implying sellers are exhausted and you just can't reach back down to these levels. So this gives you a slight edge, implying impending price action to the upside, which we did have follow through from this low to the next low. Higher levels of negative momentum ushered in a nice rally back up to the top of the channel here. All right, so your fifth key that I have for you is going to be a Japanese reversal candlestick. These are essentially the psychology of market participants, buyers and sellers. And these candlestick formations can usher in significant rallies depending on their implications. So for example, this is a bullish engulfing candle, but not only that, it's also called a three-line strike. So what you're doing is you're engulfing not just one trading day, two trading days, three trading days, but you're engulfing 4 prior trading days with one bullish engulfing candle. Technically, for a three-line strike, you just need to invalidate the 3 prior trading candles, but this one is so strong it's invalidating 4. And it's not always about the reversal candlestick itself, it's about the follow through. So you'll notice on the next day, which would be a gap up and engulf at least 50% of the body candle, this is going to be a dark cloud cover. So you have a bullish pattern followed by a bearish pattern. Typically on a dark cloud cover where you engulf 50% after gapping up, you would want to see follow through to the downside. You didn't do that in this case. You continued your momentum back up to the upside, had some selling pressure, and then what did you do again? Another three-line strike to where you engulfed 1, 2, 3 prior trading days, and you saw follow through on the next 2 candles. So this is the initial pattern that you could play. So when you do see this pattern happen, you could put your stop marginally below the candle close or the candle open. And if you do see prices come and make a candle close below the opening of this candle, it now is validated. And once you see follow through, you know that you can't play this any longer. So what you're looking for is these kind of reversal candles implying more upside based on market participant psychology. Another candlestick pattern I like to bring to your attention is the tweezer top and tweezer bottom. You'll notice here where after you've had a nice bullish run up, you have here at the top of the range a bearish engulfing candle, implying more selling pressure is to come, calling this a tweezer top, tweezer top, tweezer top, tweezer top. And you can also have these be ushered in at the bottom of a range too, where you'll see selling pressure to the downside followed by an immediately bullish engulfing candle with price resumption to the upside. Tweezer bottom. You can also see another example here of a tweezer top, followed here at the bottom of a range, tweezer bottom. Another candlestick pattern I like to bring to your attention is the shooting star. Yes, this one is a green shooting star, where you're at the top of a range and you have a longer wick than you do body, implying buyers are exhausted, sellers are stepping in when you're seeing immediate reversal to the downside. Shooting stars don't have to be red or green, they can be either. I do prefer them being red, but what's most important is having a longer wick than body and follow through. It's not always about the initial pattern itself, it's about follow through. Is there confirmation? Is this a valid pattern? And that's always identified through follow through. Okay guys, and so for the sixth and final secret key that I have, since you've made it to the end of the video, is also taking trades at the pattern completion zone of a harmonic. So for this example, this is Tesla with a bullish bat. So you have your X, your A, your B, your C, and your D point. Your D point of the completion zone happens to be confluent with the key level of historical support and resistance. Resistance, support, 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 support. At a 886 retracement from your previous swing low to high, with the Bukowski pattern of a double bottom at the historical inflection point, with a Japanese reversal candlestick pattern, with a tweezer bottom, with bullish divergence on your MACD and bullish divergence on your RSI. This will all usher in a nice reversal and a more high probable trade where you could measure up with a stop loss marginally below 209.07 for a high risk reward trade. So those are going to be the 6 keys to having a high probable swing trade. 1. Having a key level at historical support and resistance. 2. Is it a 786 or an 886 from your previous swing low to high? Is it in a Bukowski pattern? Do you have bullish or bearish divergence on both oscillators? And is it at the end of a Japanese reversal candlestick pattern, also at the end of a pattern completion zone of a harmonic? Looking for these variables is like tea cake. Do you have the eggs? Do you have the flour? Do you have the frosting? Do you have the cocoa powder? Do all of these variables align, and is it in the oven baking? This is what you want to look for to take a long fresh position, or if you're looking to short, you just inverse your chart from the bullish perspective and all of these variables just apply them bearishly. This is going to give you a high probable successful trade to where then you could set up a nice swing trade for a 3-to-1 risk reward ratio. Alright guys, thank you so much for going through this video with me. If you liked what you saw, please hit that bell, that like, that sub. You'll know when I go live or post any new videos. And of course, if you have any comments or questions, please leave them below for me. And I'll see you next time.